All right, welcome back to your ultimate exam prep power hour. If you've been staring at your Week 11 financial accounting notes until the standards start looking like ancient hieroglyphics, you are exactly where you need to be. Today, we're going to decode the absolute trickiest parts of this lecture together.
Picture this. You're sitting in the exam hall, the clock is ticking down, and you suddenly freeze up trying to remember if an error is fixed retrospectively or prospectively. It's the worst feeling, right? We have all been there. It is totally normal to feel that sheer panic when trying to match the right accounting treatment to a confusing scenario. Getting it wrong can cost you massive points. But don't stress, because today we are going to build some mental cheat codes so that never ever happens to you again.
Here's our game plan for today's explainer. We'll master policies, tackle the showdown between policies and estimates, learn how to clean up past errors, navigate post-reporting events, and finally, we'll crush a practice question.
Let's dive right in with Section 1, Mastering Accounting Policies, the Rules of the Game. We're laying down the foundation here with AASB 108 and IAS 8.
So, what actually is an accounting policy? Well, the standard defines them as the specific principles, bases, conventions, rules, and practices a company applies to prep its financial statements. Basically, think of these as the overarching rulebook a company chooses to play by. Like deciding between the cost model or the revaluation model for your property, plant, and equipment, or picking between FIFO and weighted average for your inventory. It's the foundation of how they report.
But here's the catch, and you'll definitely want to star this in your notes because professors absolutely love testing it. You can't just go changing these rules willy-nilly. There are literally only two permitted circumstances for a policy change. One, a brand new accounting standard drops and forces you to do it, or two, you make a voluntary change, but only if you can explicitly prove it makes your financial reporting significantly more reliable and relevant. If you don't meet one of those two strict bars, your policy stays put.
All right, moving right along to Section 2, Policies versus Estimates, the big showdown. Now we're stepping into what is arguably the most highly tested concept in this entire module.
You need to burn this into your memory for exam day. The difference between handling a policy change versus an estimate change is night and day. A policy change, that has to be applied retrospectively. You literally have to go backwards in time and restate past financials as if you'd always been using this new policy. But an estimate change is applied prospectively, meaning you draw a line in the sand and moving forward you only adjust the current and future periods. Mixing up retrospective and prospective application is a classic way to bleed points, so keep this distinction locked in.
Okay, but what happens when you're reading an exam question and it is just genuinely ambiguous? Like, you literally can't tell which one it is. Enter the default rule. When in doubt, treat it as a change in estimate. The standards recognize how tough this is, so if it's impossibly difficult to distinguish between the two, you default to the estimate. Why? Because going backwards and doing a retrospective restatement is a massive logistical nightmare. It's a pragmatic rule, and it's a super easy point to score if you spot it.
Let's keep that momentum going into Section 3, Fixing Prior Period Errors, Cleaning Up the Past. Even the absolute best accountants mess up, so we need to know how to handle it.
Now, errors can pop up from all sorts of places. We're talking simple calculator slip-ups, fumbling the application of those accounting policies we just covered, totally missing key facts, or, outright fraud. But here's the kicker. Whether someone made an honest math mistake or purposefully cooked the books, the accounting standards don't care. They dictate the exact same way to fix material errors from past years.
And that fix is retrospectively. Seriously, underline this. When you uncover a material prior period error, you have to fix it retrospectively in the very first financial statements you issue after finding it. You basically have to act like the mistake never even happened, and you go back and restate those comparative amounts.
Now you might be wondering, is there a get-out-of-jail-free card here, an exception to going backward? Technically, yes, but the bar is incredibly high. You can only avoid retrospective application if the fix is genuinely impracticable. And that doesn't just mean it's going to be expensive or annoying or take all weekend. It means there is a total inability to apply the requirement after making every reasonable effort, like the historical data literally just doesn't exist anymore. Only then can you pivot and apply it prospectively.
Almost done with the theory. Let's hit Section 4, Events After Reporting Date, After the Bell. What actually happens when a major event drops right after year-end?
This is basically a binary cheat code for your exam. You've got two buckets for events that happen after the reporting period but before the statements are authorized. First bucket, adjusting events. If the event gives you more evidence about a condition that already existed exactly at the end of the reporting period, you must actually go in and change the numbers in your financial statements. Second bucket, non-adjusting events. If the event points to a condition that popped up entirely after the reporting period, you leave the numbers alone and just disclose it in the notes.
Professors absolutely love setting traps here. A classic one, the settlement of a court case right after year-end. If that lawsuit was already hanging over your head during the year, that's an adjusting event. Another one is a customer going bankrupt just after the reporting date. That bankruptcy basically confirms their receivable balance was already impaired at year-end. Because these events shed light on conditions already present, you have to adjust the actual numbers. Do not fall for the trap of just throwing it in a disclosure note.
All right, time to bring it all together and see what we've learned. Section 5, Acing the Practice Question, featuring Falcon Manufacturing. Let's build that confidence.
Okay, scenario A. Falcon changes its depreciation method from straight line to diminishing balance because new information shows the machinery's benefits are actually consumed faster in the early years. This creates a $40,000 difference for the current year. On the exam, ask yourself right away, is changing a depreciation method a change in policy or a change in estimate based on new info? Lock your answer in.
If you guessed estimate, boom, you hit the nail on the head. It's an estimate change because it's based on new information about the asset's useful life. And since it's an estimate, you apply it prospectively, meaning you just book that extra $40,000 of depreciation in the current year. Easy. No messy retrospective restatements of prior years.
Now, let's look at scenario B. Falcon changes its inventory cost formula from weighted average to FIFO because management believes it'll provide more relevant info. This causes a $65,000 increase to opening retained earnings. Think back to our very first rule. What category does swapping an inventory cost formula fall into?
Yup, for sure. That is a change in accounting policy. It's a voluntary change to provide more relevant information. And the rule is clear. Policy changes demand retrospective application. You've got to roll up your sleeves, go back, and adjust the past by bumping up that opening retained earnings by $65,000, exactly as if they had been using FIFO the whole time.
Look, take 15 minutes tonight to just drill these binary rules into your head. Really understand the line between a policy and an estimate, and memorize adjusting versus non-adjusting events. If you do that, you will walk into that exam room completely bulletproof. But I want to leave you with one final, slightly provocative thought. We just saw how much easier it is to change an estimate prospectively than to retrospectively restate a policy change. So, how often do you think real-world companies conveniently use the estimate default rule to subtly sweep their past financial misjudgments under the rug? Keep that in the back of your mind, trust your study structure, and I'll see you in the next explainer.